For decades, building wealth felt almost predictable. You didn't need to be a genius. You didn't need insider knowledge. All you had to do was invest in the S&P 500 and wait. And if you stayed patient, you won. But today, for the first time in a long time, I'm questioning that strategy, not because it failed, but because the world around it is changing faster than ever before. And the reason? AI. Let's go back for a moment. Why did the S&P 500 work so well? Because it removed complexity. Instead of trying to pick individual stocks, you simply bought the entire market. That means you own companies like Apple, Microsoft, Amazon. And as these companies grew, so did your investment. No stress, no guessing, just long-term growth. On average, around 10% per year. Over decades, that compounds into serious wealth. But here's the uncomfortable truth. The S&P 500 today is not the same as it used to be. On paper, it's diversified. 500 companies sound safe. But in reality, it's heavily concentrated. Because nearly 40% of your investment is tied to just a few companies. Nvidia, Microsoft, Apple, Meta. This creates a hidden risk. Because if these companies struggle, your entire portfolio feels it. That's not diversification. That's dependence. Now let's talk about what's really driving this shift. Artificial intelligence. Right now, we are witnessing a modern-day gold rush. Every major tech company is racing to dominate AI. They're spending billions on chips, infrastructure, and research. Companies like Nvidia are at the center of it all, because without their chips, AI doesn't run. But here's where things get interesting. This isn't just growth. It's expectation-driven growth. Investors aren't buying based on today's profits. They're buying based on what might happen in the future. And history has shown us something very important. When expectations get too high, reality eventually catches up. So the big question is, are we in a bubble? Not necessarily. But the risk is increasing. Because for current valuations to make sense, these companies would need to generate trillions in revenue. And that's a massive assumption. Even companies like OpenAI are spending aggressively while still building their revenue base. This creates pressure because if growth slows even slightly, investor confidence can shift very quickly. There's another layer to this, a feedback loop. Here's how it works. Big companies grow. Index funds invest more into them. Their stock prices rise. Their weight in the index increases. Even more money flows in. And the cycle continues. This makes the system look strong, but it also makes it fragile because it relies on continuous growth. So I made a decision. I reduced my exposure to the S&P 500, not completely, but enough to protect myself. Because I don't want my financial future depending on one trend, no matter how powerful that trend is. Then I zoomed out and asked a bigger question. What if the next decade doesn't belong to the U.S. alone? History tells us. Leadership always changes. There was a time when the UK dominated global markets. Then Japan. Now it's the United States. But nothing lasts forever. That's why I started looking globally. Part 8 Global Opportunities, 1730-1930. When you invest globally, you gain access to companies like Samsung, Toyota, Tencent. These companies are leaders in their industries, and they operate at a massive scale. Yet many investors ignore them simply because they're not in the U.S. Now here's the most important part of this video. The real winners of the AI revolution may not be the companies building AI, but the companies using it. Think about it. When technology becomes widely available, it becomes a tool. And tools don't create value by themselves. People do. Businesses do. Small and mid-sized companies are now using AI to automate workflows, cut costs, improve efficiency. And they're doing it without spending billions. That's where I see massive potential. So here's what I'm doing now. Reducing concentration in big tech, diversifying globally, investing in small and mid-cap companies, focusing on AI adopters, holding some gold for stability, because in uncertain times, balance is everything. AI is not just another trend. It's a shift, a massive one, and shifts like this create winners and losers. The people who succeed won't be the ones following the crowd. They'll be the ones who adapt early, who think long-term, who stay ahead. So ask yourself, are you investing in what worked yesterday or preparing for what comes next?